Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be the Wednesday, pardon me. Today will be Wednesday, the 11th of September 2024. Very good morning to all. So before we jump straight into our gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so very good morning for those who just joined us. Today will be Wednesday, the 11th of September 2024. So as usual, before we jump straight into the short-term intraday technical outlook on the various broad-based cross asset classes, let's have a quick recap what has taken shape yesterday in terms of yesterday and as well as earlier this morning, which is just a while ago, about 10 to 20 minutes ago. We just have the conclusion of the US presidential debate between Harris and Trump. Later, I'll touch more about that when we go through the motion of our daily dose for today, and as well as other key events that took shape yesterday and as well as today that impact the movement of the various respective broad-based cross-asset classes. All right, so before we start over here is that maybe let me do a quick check of my mic so that I hope that everything is working fine. All right, over here. Okay, so I hope that everything is okay. All right, so let me start with yesterday's key news first. All right, so yesterday key news during the US session was this particular kind of, I would say that rather negative news flow concentrated on the US banking sector that actually led to the underperformance of the Dow Jones Industrial Average, because we know that the Dow Jones Industrial Average, JP Morgan, Goldman Sachs has a higher weightage in the Dow Jones Industrial Average comparatively to the S&P and the Nasdaq 100 that are heavily weighted by the mega cap technology stocks. So the Dow Jones actually went down negative 0.23% at the end of yesterday's session, whereas the Nasdaq managed to continue its mean reversion rebound that we highlighted at the start of this week daily dose, outperformed by 0.9%, led by those mega cap technology stocks that has reached oversold region on last Friday. And follow suit will be the S&P 500 up 0.45%. The Russell 2000 is also down negative 0.8%. So talking about this Dow Jones Industrial Average, why they underperform, I mentioned earlier, is due to a basket of US financial stocks, and there's this particular news flow over here where during a we call it during a industrial conference. All right, it's not earnings announcement, industrial conference. One of the senior management in JP Morgan actually mentioned that next going forward over here, JP Morgan, okay, let me highlight to you all in bold over here, right? So JP Morgan mentioned dial back expectation for next year net interest income, whereas there's this particular auto lender, Ali Financials, so it's more like a regional bank, sounded a warning bell on consumer credit metrics over here. All right, so because of this kind of we call it kind of negative adverse guidance by major financial institutions in the heat map of the S&P 500, we saw them actually underperform. JP Morgan down negative 5%, and it dragged down to other banks as well, where we have Citibank down negative 6.7%, okay, down negative 2.67%. And also what we could see over here is that energy stocks also underperformed because yesterday the West Texas crude oil broke below our key short-term pivotal support at around the $68 per barrel and plummeted all the way down close to around the 65 or $66 per barrel. That's the kind of the intraday low. So later we'll touch more about the oil, why oil price has been so weak yesterday. So if you break down into the groups, the sectorial, the 11 sector breakdown of the S&P 500. So very clearly, yesterday our performance was in the technology stocks as well as the real estate. So a very outlier comes with the financials because all of them are actually managed to be in the green for the financials due to that very industry specific negative news flow where particularly a senior management from JP Morgan, which is a major US bank, giving a bit of negative forward guidance on their income revenue prospect for next year in a financial institution specific conference, not earnings, but in a conference that is spoke. So market took it as negative and sold off US financial related stocks yesterday. So energy was down due to a very weak oil price. So let me talk about this energy over here since we talk about energy. So what causes the fall in energy stocks was related to weaker oil price that broke down below the key short-term pivotal support that we highlighted yesterday in West Texas crude oil at around that $67.80 per barrel. So this was actually led by the monthly OPEC report, which OPEC tend to publish monthly, given the highlighting the state of condition in the global oil market. So what OPEC did, it lowers its 2024 and 2025 global oil, we call it intake or oil demand due to a lackluster demand up from China. So what it did over here, it cut its forecast for global oil demand growth in 2024, reflecting the data received so far this year. This is more pertaining to the very weak core consumer inflation data that was out from China earlier this week. All right. So what he did over here is that he trimmed down the barrels per day consumption for 2024. Previously, they are expecting at 2.03% million per day, and they trim it. They trim it down to 2.03 million barrel per day in 2024 from 2.11 million barrel per day expected last month. All right. So because of this lowering of global demand for oil by the cartel OPEC Plus over here, it fit onto a negative feedback loop in oil prices yesterday, which translate to a very weak energy US sector in terms of a sectorial perspective. All right. And also one particular news flow and highlight to your early this morning is more pertaining from the FX market over here. So the FX market over here is that one of the BOJ board member, Nakagawa, actually he signals that a possible rate hike still remains on the table before 2024 ends. So that causes the yen to actually strengthen against the dollar. And with that, if you look at the heat map of the FX market, which I tend to share with you all every day on a frequent basis, by looking at this very short-term 5-day rolling performance, okay, of this situation. So what you could see is a current outlier over here, the yen strengthening against the dollar or the dollar punching against the yen, right, over here, and it's now dragging the rest of the other currency as well because I use dollar as a base currency against the rest of the world. So what we could see is that the dollar also starts to weaken against the Aussie, the Kiwi, the CAD, the sterling, the euro, and most remarkably is weakened significantly against the yen after that rather hawkish speech from that BOJ board governor Nakagawa. So bear in mind over here is that for those who follow our daily dose on a frequent basis, on Monday we do highlight that the yen, whatever bounce on the yen, on the dollar yen, to be precise, on the dollar yen is just a mean reversion rally. The bigger term trend, that means i.e. the multi-week trend of the dollar yen still remains on the bearish side, supported by intermarket dynamics, which I'm going to touch on later on. All right, so hold your guns first. Okay, I'll touch on later on. Okay, so another particular news flow I share with you all is the conclusion of the debate between Donald Trump and Kamala Harris over here. So what is the outcome over here is that for sure Kamala Harris performed much better than Biden. So if you look at the current live market, live So poly market is one of the leading, we call it prediction market, that actually based on betting odds between Trump and Harris. So all of them are actually now neck to neck, 49%, 49%. And for those who followed my daily dose yesterday, I do share with you all that Trump was actually leading before the debate took shape at around 53%. So right now, both of them is on par after Harris much better performance than what market is expecting, because we know that some of the Trump supporter actually mentioned Harris couldn't speak on her own in a live stage environment, but I do hear myself personally just a while ago that she did perform way beyond her even her supporters are expecting, and her distractor are expecting as well. So that actually saw the live betting market right now by poly market, given between the odds between Trump and Harris now break even neck to neck. So going forward, it's going to be a kind of a coin toss over here, because there's no clear indication that one is leading over the other. Right, so this is the current state of the U.S. presidential election race going on right now. All right, so with that, now let us now focus our attention now to the fundamental and the intermarket dynamic segment. So let me touch on the FX market. So very much I shared with you earlier on why I still do expect the medium-term downtrend of the dollar yen is still intact, and whatever rebound that we see so far since the start of this week is more mean reversion rebound, is due to this particular where was I? Yes, the yield curve. Okay, not the yield curve, the yield spread between the US Treasury yield and the JGB yield. All right, so still I mentioned over here is that I take into account of the 10-year and the 2-year. So the 2-year tends to be much more reactive. Why? Because it react more to the respective central bank policy, whereas the 10-year take into account of growth and inflation risk perspective of the various countries. So now, if you look at the 10-year spread between the 10-year US Treasury yield and the 10-year JGB yield, so I did mention earlier on there's this key major support at 2.9%. All right, that 2.9% that managed to help since August. All right, August, all the way continue to help until it broke yesterday. All right, it broke yesterday during the US session and going to inch downwards to shape lower low. Okay, lower low. So what it means over here, okay, where am I? Sorry about that. Let me expand this screen. Yes, so that you guys see much more clearer. So what it means over here is that the yield spread between the 10-year Treasury note versus the 10-year JGB, the premium is getting lesser and lesser, and the premium may continues to shrink more going forward in a multi-week perspective, because it's a daily chart, by the bearish breakdown just yesterday of that 2.9% major spot that held it since late January and late January, late January 2023, has been broken down decisively on the downside yesterday. So indicating to us that going forward from a multi-week perspective, this yield shrinkage will shrink further. That means, i.e., it's no longer attractive to use a carry trade by the Japanese yen as a funding currency and invest in longer term US sovereign bond, because the treasury market is a sovereign bond. It's no longer attractive. That means what it also imply over here is that US inflation potentially may go down at a faster pace than Japanese inflation, because the 10-year yield of both countries also can be used as a proxy over here. That means the 10-year Treasury yield, the 10-year JGB yield can be used as a proxy of the respective country inflation growth trajectory going forward. This is what I'm trying to explain to you guys. All right. So in fact, finally, it broke down below the 2.9%. But however, the 2-year breakdown much earlier at this parallel 3.84% level in August. All right. So now with the 10-year now breaking down, the 10-year spread, I would say the 10-year spread between the 10-year US Treasury and the 10-year JGB breaking down below the 2.9% yesterday, further give evidence to us that potentially the honest for the medium term trend of the dollar yen is more skewed towards the bearish side rather than the bullish side of the story. Right, so this one intermarket dynamics on share with you. So another intermarket dynamic on share with you is oil price right now, the current state of oil price right now, in relation to future inflation trend in the US, because that's going to guide the US Federal Reserve monetary policy going forward, and also ahead of tomorrow's inflation data, ahead of tonight, this evening inflation data released in the US. Okay, so this particular chart, I believe that some of you who actually followed my daily dose on a frequent basis, I do share with you as well, is actually looking at oil price in comparison to the Fed funds rate, in comparison to the 10-year US Treasury yield, and also in comparison with the 5-year break-even inflation and the 10-year break-even inflation. So just think about it, nothing too much rocket science. For those who know what is a break-even inflation, is a proxy of future inflation going down the road determined by market transacted instrument. So how do market get this 5-year break-even inflation rate, which is now at 1.86%? All right, how do they get it? It's basically get the nominal US 10-year treasury yield that is being traded in the market, in the treasury market, minus off TIPS, treasury inflation protection bonds. That means that is a bond that you will get minusing off inflation rate. Okay, it's not a very big market in US, but it's a tradable market. So you minus that off, the yield off, you're able to get the break-even inflation. So think about it as a 5-year break-even inflation is a market transacted instrument. What market is expecting US inflation will be 5 years from now. And this number is dynamic because it's based on a market transacted instrument. And a 10-year break-even inflation, just think of it, is that what is the inflation rate will be in the US 10-year from now. All right. And I want to share very interesting. These two lines, the 5-year break-even and the 10-year break-even, move in direct synchronization or in tandem with the movement of WTI crude. And you realize that since August, late August over here until today, the steep fall in the 10-year break-even inflation rate and the 5-year break-even rate has come in line with the significant fall in the WTI crude oil since late August this year. All right, late August this year, it's going to fall down dramatically over here. And this fall, these three fall also coincide very, very significantly to the fall of the 10-year US Treasury yield in purple over here. Like I mentioned earlier on, just now I shared with you all the spread between the US 10-year Treasury yield and the spread between the 10-year Japanese JGB bond yield. The 10-year US Treasury yield can be used as a proxy to estimate can be impacted by the inflation growth trend in the US. So this is why it's being seen very obvious. All right, the 10-year break-even inflation year is falling down. It actually led to the fall down in the US 10-year Treasury yield as well, the break-even. And don't forget, these are future inflation trend in the US. We know that the Fed has a long-term mandate to keep inflation down to 2% growth, and the mandate has already been hit today. How do I know that? By looking at the 10-year. 10-year is a longer term compared to 5-year. The 10-year break-even inflation rate telling us 10 years from now where inflation is likely to be is already hit 2%. The Fed has already met its mandate. So what you could see over here is that currently the Fed funds rate is hovering at this level over here, 5.25%. To 5%. All right, it didn't change. That means what is telling us that the Fed is late in the game. All right, is late is one thing, and perhaps the Fed may not need to cut interest rate as aggressively as it should. Potentially, why? Because the longer term break-even inflation has really come down to 2%. But that could be a problem going forward, because if this 10-year break-even inflation rate doesn't pause here, that means let's say the 10-year continue to go down below 2% at 1.8%, 1.6%, that means it's going to plummet downwards. That means there is a potential growth slowdown in the US. Okay, think about it. What caused inflation to go down? That means there could be less demand of goods and services. That means people don't spend as much as they should be. Then inflationary price of goods should come down, price of services should come down to adjust, and that should bring inflation growth trend deceleration on the downside as well. That means, i.e., if market transacted instrument implied that the 10-year break-even rate going to trend much lower below 2%, then the Fed has a problem. That means the Fed will be late in the game, and this is where they may be forced to cut at a faster pace 3 to 4 months down the road. That means going into next year as well. Something that we got to monitor the trend of the 10-year break-even inflation rate trend. All right. So if that actually takes shape, if this scenario holds, that means, i.e., the Fed is late in the game, the 10-year break-even inflation rate trending down below 2%, that means, i.e., there could be a potential, it implies a demand slowdown has taken shape in the US economy, increase the risk of a US recessionary scenario, and that could be negative for risk assets. That means, i.e., there could be another potential down movement. Firstly, in the higher beta major US stock indices, which I stressed on in my daily dose earlier on, concentrated on the much more richly valued mega cap technology stocks. One of the leader will be NVIDIA because of the AI optimism team play, and that could actually drag down in first step the Nasdaq 100 first, and if it doesn't stop, it could spread down firstly to the S&P 500 and eventually the Dow Jones Industrial Average, even though they are not heavily weighted by technology stocks, but they do have certain cyclical factors of stocks over there. The Dow Jones Industrial Average may not perform as well as expected. That means they may go sideways rather than hitting fresh new all-time high. Right, this is something I want to share with you all from a fundamental and intermarket dynamics that has a higher time horizon, multi-week to multi-month rather than intraday. All right, so with that, now let us now shift our attention to the very short-term perspective, which is the intraday technical outlook for today on the various major cross asset classes that I share with you all. But firstly, let me expand my screen first so that you guys have a better visualization on the chart. All right, so now let us start our focus now on the FX market. All right, so on the FX market over here, let us start with the euro dollar. Still remember the euro dollar on Monday, we do expect the price to gently trick downwards, but remember this fall of the euro dollar is more like a mean reversion decline rather than a change in the a very what I call longer term, medium term downtrend in the euro dollar, because the medium term trend on the euro dollar is still bullish. Why? Because the euro dollar going to trade above the 50-day moving average, and the 20-day moving average is still above the 50-day moving average. All right, so for those who are new to trading view, let me stress this is the hourly chart of euro dollar, but the moving average, what I plot over here, is a daily chart, a daily moving average rather than a 20-hour moving look back period of the moving average, because in trading view we are able to do multi-time frame analysis on a single chart. All right, over here. So with that, the price action came down, almost hit the 1.026 first support level, and it hasn't hit the second support level at 110 that I highlighted yesterday. It haven't hit this support level, and because there is a positive development now that has taken shape in the hourly RSI. So the hourly RSI now has shaped a very clear bullish divergence. All right, very clear bullish divergence after the slight breakdown of the 1.1026 level, and can't hit the 110 short-term support level. All right, so I want to use yesterday's minor swing low. Okay, so yesterday we have a minor swing low over here as my short-term pivotal support, for today. Okay, which is this level at 1.11015 level. So I will still use 110 level over here. So this 110 level will be a short-term pivotal support level for today. Why? Because of the occurrence of this bullish divergence that's being flashed out right now on the hourly RSI, indicating to us that sell-off on the euro dollar exposed non-farm payroll data. The momentum, the downside momentum, is losing strength. So with that, I couldn't be holding on to my intraday bearish bias on the euro dollar because element doesn't justify me to do so. All right, so instead for today, I will use 110 short-term pivotal support level as a level to watch to flip to a intraday bullish bias on the euro dollar first near-term resistance to watch on the intraday basis, 110.89. For sure, this is an important level. Graphically, minor conjunction, and as well as the 20-day moving average coincidentally confluencing at the same level at 110.89 as well. Only a breakout above 110.89 on the intraday basis. On the intraday basis, may revisit last Friday non-farm payroll minus swing high area at 111.40. Okay, so these are the two short-term intraday resistance level to watch out for on a intraday basis for today. However, if price action starts to come down and break below 110 figure short-term pivotal support level with an hourly close below it, then this intraday bullish bias will be invalidated, and even to see the continuation of this minor corrective decline scenario unfolding to test the next near-term support level at 1.0950, which also confluence very closely to the 50-day moving average. Only a further breakdown below 10950, then the medium-term uptrend of the euro dollar will be in jeopardy, and potentially it could potentially also expose the next near-term support level now at 1.088 next, which confluencing with the 200-day moving average. Okay, so that's for the euro dollar. Moving on will be the sterling dollar. So on the sterling dollar over here, price action also come down. Okay, almost hit our first support, the support level that we highlighted yesterday, which is a zone 130.40/130.10 over here, and now it's trying to play around the 20-day moving average that is still upward sloping for now, and price action going to hold above the 50-day moving average, so indicating that the medium-term uptrend on the sterling dollar still remains intact as well. And what's significant over here is that it also shows the similar momentum in intraday momentum condition as the euro dollar, as price action continues to trend downwards, heading towards our first support level that we highlighted yesterday in our yesterday's intraday bearish bias. The sterling dollar flashed out a bullish divergence, and given this flash out of a very clear bullish divergence yesterday, the odds of it shipping down to break below 130.10 and hitting 1.2940 is quite remote at this juncture, because this bullish divergence in the hourly RSI indicating a slowdown of that downside momentum that took shape since ex-post non-farm payroll data release. And with that positive element that's being seen right now currently on the sterling dollar, we will flip from a bearish bias to a intraday bullish bias for today, using 130.40, 130.10 as my short-term pivotal support level. Near-term resistance level to watch for today will be 131.40, followed by 132.20, which is the minor swing high area of last Friday after the release of the non-farm payroll data. Only a breakdown below 130.10 with an hourly close below it will invalidate today's intraday bullish bias to see the extension of the mean reversion corrective decline scenario towards 129.40, next support level to watch, which is also confluencing with the rising 50-day moving average as well. So that's for the sterling dollar. Turning our attention now to the Asia Pacific currency, starting with the Aussie dollar. So the Aussie dollar continues to hold right at the 66.40 short-term pivotal support level. So no change, price action continues to trade sideways this level throughout yesterday's US session and including today's Asia session as well. So no change, I'll be still using 66.40 short-term pivotal support level to maintain a short-term intraday bullish bias for a bounce, potential minor bounce scenario to come in the Aussie dollar. First near-term resistance level to watch will be at 66.90, no change. A breakout above it exposes 67.10, we also confluence very closely to the 20-day moving average as well. All right, let me highlight it over here. So it's very similar, like a zona 67.10/67.20 level. Only a price breakdown with an hourly close below 66.40, then this intraday bullish bias will be invalidated on the Aussie dollar to see the continuation of this corrective decline scenario unfolding to test the next near-term support zone at 66.10/66 figure level, which confluence with the key long-term 200-day moving average, I think as a support level as well. A breakdown below 66.10 that will expose further weakness on the Aussie dollar towards 65.70, which is the minor swing low area of 9th of August and 15th of August. Okay, so that's for the Aussie dollar. Turning our attention will be the dollar yen. So the dollar yen, yesterday we do have a short-term intraday bullish bias looking for it to test the 44.30 level. A breakout above 44.30 exposes the 20-day moving average at 45.40 slash 145.90. So price action can't hit that level and break down. And what we could see over here is that the hourly RSI also break down below this parallel minor ascending trend line support as well, now hitting the oversold level. So far there's no bullish divergence, I mean not the kind of bullish divergence that we saw previously on last Friday over here. Okay, that led to this minor bounce on Monday and Tuesday, but then there's no positive follow through to test the 144.30. So given it's really hit the oversold level and is now testing last Friday's support level that we highlighted before the non-farm payroll, which is the 141.760, 141.40 level. Okay, where was I? Okay, let me put in another line over here. Okay, this line here, 142.70. So that could be a bounce back towards the 142.70 level on the intraday basis. But as long as this bounce shouldn't surpass 144.30 short-term pivotal resistance, pardon me, 144.30 will be my short-term pivotal resistance that we have for today. We will flip to a intraday bearish bias on the dollar yen. For sure, right now at risk of a breakdown below 141.60/40, which is the minor swing low area of 5th of August. And that could potentially kickstart another round of impulsive now down move on the dollar yen to expose the next near-term support level at 140.25. Thereafter 130 figures /138.75 next. Only a price bounce above 144.30 means back above this level 144.30 that would invalidate today's intraday bearish bias on the dollar yen to kickstart another mean reversion, much more extensive mean reversion rebound scenario towards 145.40/90. Above it potentially may revisit 147.30 next. So that's for the dollar yen. So with that, now let us now turn our attention to the major benchmark stock indices, starting with the Hong Kong 33. So the Hong Kong 33 coins remains weak right now. So what we could see now is that price action now is breaking below the 16,690 short-term pivotal support level that we have, looking for a bounce to take shape yesterday, and unfortunately this bounce didn't take shape and starts to break down again. So with this breaking down intraday of this 16,690 level, we will not maintain our short-term intraday bullish bias for now because the latest price action doesn't justify for it to do so. So with that, I will flip to a short-term intraday bearish bias using yesterday's US session high over here as my short-term pivotal resistance level for today, which is at 17,180. Okay, so this will be my short-term pivotal resistance level. Okay, so given that this level is now breaking down, the next near-term support level, okay, let me delete. Okay, yeah, the next near-term support level to watch on the Hong Kong 33, the Hang Seng Index, will be at 16,716 level. All right, so a breakdown below it potentially revisit the 5th of August and the 7th of August minor swing low area at 16,500/16,424. All right, so only the price managed to recover back above 17,180 that would invalidate today's intraday bearish bias on the Hong Kong 33, i.e. the Hang Seng Index, to revive the mean reversion rebound scenario to kind of test the next near-term resistance level at 17,330, a breakout above it, potentially revisit the 50-day and the 200-day moving average, acting as a graphical resistance zone at 17,500/17,595. So that's for the Hong Kong 33. Now, turning our attention to the Japan 225 or the Nikkei 225. So given the fact that the Nikkei 225 on the very short-term basis seems to have a kind of a direct correlation with the dollar yen, given that the dollar yen now potentially has a turn week, so it can't have any headway above the first resistance that we highlighted yesterday at 36,540. So with that, we will have a neutrality stance for today instead, That means kind of a sideways movement. So turning neutral. Let me put it over here. Okay, so this will be our neutrality range. Okay. Okay, so let's say given the weakness of the dollar yen, and in the very short term intraday basis, the dollar yen do have some direct correlation with the Nikkei 225 or the Japan 225. Hence, we do not have the conviction for the dollar yen to break above 36,540 at this juncture. So with that, we will flip to a intraday neutrality stance for today of the Japan 225, i.e. Nikkei 225, between 36,540 and 35,115 for today. Right, so that's for the Japan 225. Turning our attention to the German 30 or the DAX itself, the German DAX. And given that yesterday also we do have a short-term intraday bullish bias, looking for it to clear above 18,470, then thereafter retesting 18,660. But unfortunately, price action came down and broke below the 50-day moving average. So indicating to us now is potentially resuming this minor downtrend that has taken shape since 3rd of September high over here. And given the reintegration back below the 50-day moving average and also a bearish reaction of it during today's Asia session right now as we are speaking, we will be not so confident to maintain our intraday bullish bias for the another leg of minor mean reversion rebound to take shape for the German 30. So with that, I'll be using yesterday's high, okay, which is very close to the minor swing high on Monday as well, at 18,470. That will be my short-term pivotal resistance level. Flip to a intraday bearish bias on the German 30. First near-term support level to watch will be at 18,160/18,005. A breakdown below 18,005 exposes the next support at 17,820, which confluencing with the 200-day moving average as well. Only an hourly close and a breakout above 18,470 will invalidate today's intraday bearish bias on the German 30 to kind of revive the mean reversion rebound scenario to kind of reinstate or revisit the next near-term support resistance level at 18,660. Above it, potentially may see 18,820 next. So that's for the German 30. Now, turning our attention to the major US stock indices, starting with the US Wall Street 30, i.e. the Dow Jones Industrial Average. So given yesterday's rather weak movement of the US financial stocks, that two of them, JP Morgan, Goldman Sachs, has a higher weightage inside the Dow Jones Industrial Average comparatively to the S&P 500. So that's why we see the US Wall Street 30 underperform against the NZD 100 yesterday, as well as the S&P 500, but still managed to hold above the 50-day moving average, I think, as a support level over here. So this could be the first support level to watch at 40,466 for today. We're also very close to the 50-day moving average, but no change. I will still use the 40,414 as my short-term pivotal support level on the US Wall Street 30. Still maintain that intraday bullish bias on it. First resistance level to watch will be a zone at 41,040/200 that has been kind of tested on almost tested yesterday as well, or Tuesday, pardon me. So no change on that, unless price action break down below 40,140, then that would invalidate today's intraday bullish bias to see the extension of this minor corrective decline to expose the next near-term support level at 39,867, 39,580 next. Okay, so now moving on will be the NZD 100. So NZD 100 yesterday hit our first resistance zone at 19,680 slash, not 19,000, pardon me, 18,680/18,800. All right, so this level has really been met. Let me remove this level over here. Okay, so the hourly RSI hasn't hit the overbought level yet, all right, over here. So at this juncture, potentially there could still be a bit more room for this mean reversion rebound to extend. So, but we will have a tightened short-term pivotal support for today, taking account of this week low, which is Monday's minor swing low as well, at 18,485. So as long as 18,485 holds for today in any potential chance of a pullback, we will still maintain that intraday bullish bias on the NZD 100 for the mean reversion rebound potentially to extend. The next near-term resistance level to watch out for will be at 18,935, followed by 19,117 next. Only an hourly close below 18,485, then this mean reversion extension rebound scenario will be in jeopardy. Then that potential short to medium-term downside movement may resume on the NZD 100. First visit will be at the 18,320, which correspond to last Friday low, and the 200-day moving average. A breakdown below it increases the odds of the start of a medium-term downtrend phase unfolding on the NZD 100, exposing the next near-term support level at 17,960 next, right? So that sum up the NZD 100 and as well as the intraday technical outlook for the major US stock index. So with that, before we go over here, I want to highlight one particular FX cross pair that I forgot to highlight when I cover the FX market. Will be this particular pair of sterling kiwi, sterling kiwi over here. So sterling kiwi, that means the sterling versus the kiwi over here, that means JPB/NZD has been trading in a very nice short-term uptrend phase since the low of 30th of August, all right? And momentum continues to remain rather positive on an hourly basis. Price action on the hourly RSI hasn't hit the overbought region yet, so I'll be using yesterday's minor swing low, which also confluence with the lower boundary of this minor ascending channel and also the 20-day moving average acting as a support level as well at 212.25. So as long as 212.25 holds on the sterling kiwi cross pair, this potential minor uptrend phase may continue. A breakout above 2.1350 exposes 2.1420 next, right, on the intraday basis, which confluence with the upper limit of this minor ascending channel. Only a bearish breakdown of the hourly close below 2.1225 will invalidate this intraday bullish bias on the sterling kiwi FX cross rate to expose the next near-term support level at 2.1140 and even to 1070. All right, so with that particular sterling kiwi FX cross pair that we could focus on, let us now shift our focus on the commodities market, starting with gold XAU/USD. So no change for gold as it's going to inch upward higher, and right now looking forward to retest the 2,532 level. So I do not want to tighten my key short-term pivotal support level to too tight at 2,493 level because it hasn't clearly broke out that 2,532 clear short-term range resistance level, which is also the close to the all-time high area that was printed in 20th of August. Yet it could potentially still continue to trap in this sideways range since 20th of August. So still no change, still using the very key short-term pivotal support level at 2,473 to still maintain a short-term intraday bullish bias. Why bullish bias? Because the 20-day and the 50-day both continues to slope upwards, all right, indicating that the short-term and the medium-term uptrend still potentially remains intact for now. Breakout above 2,532 finally may see the extension of this impulsive upmove sequence to expose the next near-term resistance zone in first step at 2,588/2,595. Only an hourly close below 2,473 potentially kickstart a minor corrective decline scenario to expose the next near-term support level at 2,435/2,415 next. All right, so that's for gold XAU/USD. Oil. Okay, so lastly will be the West Texas crude oil. So West Texas crude oil, if you look at this situation yesterday, because of the negative news flow out from the OPEC, latest demand forecast out on its monthly report for 2024 and 2025 that has been revised downwards, causes oil price to break below 68.20 short-term pivotal support level, and right now it came down, hit our next support level, now turns into a pullback resistance over here. Okay, at this 65 55 67 figure level. Okay, 6755 level. Okay, so with that, no change. We can't be playing for any potential bullish minor mean reversion rebound anymore because prices has been rather negative at this juncture, and over here, what we could see, yes, we do see an oversold on the RSI, but there's no bullish divergence on the RSI, indicating to us that the momentum could still continues on the downside for West Texas crude oil, even on the intraday basis. So I don't put my pivotal resistance so tight on this pullback resistance here. So this could be a first resistance level to watch, 67.55, but using a 68.20 level as my short-term pivotal resistance is much more sensible. Why? Because this level managed to help previously since last Friday before clearly breaking down above yesterday. So it tends to have a very much more significant psychological level as compared to 67.55. So using as long as any potential minor bounce that didn't surpass 68.20, short-term pivotal resistance that we have for today on the West Texas crude oil, we will flip to an intraday bearish bias again on West Texas crude oil. Next near-term support level to watch 65.10. A breakdown below 65.10 exposes the next support level will be at 62.80/61.85, which is close to the 2.618 Fibo extension level as well, taken from the high of 26th of August. And graphically, that is the swing low area of 20th of May, 20th of August, and 2nd of December 2021. So mind you, that is actually the low that was seen around 3 years ago. Okay, only an hourly close back above 68.20, then that would invalidate today's intraday bearish bias on West Texas oil. Then that would revive the mean reversion rebound scenario to expose the next near-term resistance in first step. Firstly, will be at this level over here, 69.37, followed by 71.15 next, right? So that's West Texas crude oil, and that also sum up the intraday technical outlook for all the major cross asset classes. So before we go, let's take a look at the economic calendar to highlight to you what are the key data to look out for, other than the US CPI data that are going to be out later this evening Singapore time. So at 2 p.m. we do have this monthly GDP growth data that is out from UK for the month of July. So market is expecting a slight increase of 0.2% for previous month of no growth. So this on a month-on-month basis. All right. So 2 p.m. Singapore time, that's for UK, and at around 5:25 p.m. Singapore time, we do have a ECB official Macau speaking, and this is the all important data for today. Will be the 8:30 p.m. Singapore time, the core inflation rate data, where market is expecting a rather low number as well at 3.2%. So that's close to, I think, a 3-year low, because this 3.2% was a low that was being hit in July. So you look at the trend of the core inflation number, it has been clearly deceleration on the downside. All right. So this is the 3.2% year on year that was better in July. So that was actually a 3-year low. So market is expecting around this similar level as well. Something to look out for that could potentially impact the FX market at 8:30 p.m. Singapore time. Then thereafter at 10 p.m. Singapore time, we do have ECB official Birch speaking. No ECB, no Federal Reserve official speaking should be speaking now, because now they have a kind of a blackout period before next week FOMC meeting. All right, then what we have next will be more pertaining to West Texas crude oil, will be the US Energy Agency, EIA in short, releasing their typical weekly crude oil stockpile change for the week ended last week at 6th of September. Data will be out at 10:30 p.m. Singapore time. So that's about all for today. And early tomorrow morning, there is no clear data except for Japan factory grade data, PPI, that potentially could have interrelation with CPI data as well. So that will be out at 7:50 a.m. Singapore time tomorrow. And at 9 a.m. we do have another BOJ official Tamura speaking as well. All right, so that's sum up today's daily dose of market insights. I'm Kelvin here signing off, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.